Hey everyone, welcome back to Upside Down Data. Today I want to talk a bit about the momentum bias indicator as it relates to Bitcoin and how we can gain some novel insights when we combine information from the momentum bias indicator with the upside downside potential indicator. So first, before I get into all that, if you didn't see our video yesterday, our website that we've made in collaboration with Jay over at Daily Crypto Analysis is now live and free to access while we're in this beta period where we're kind of testing out the waters, getting feedback from folks, and trying to make whatever improvements we think are best to make before kind of going out of the beta phase into the official version of the website. So, if you haven't seen it before, made a video yesterday, a lot of great stuff on here. We have this dashboard page that gives current levels of all the different models that we have. So the models that we've created, the upside downside potential indicator, momentum bias indicator, trend confidence indicator, and market direction classifier. We also have content that you can go and read. So we have articles about the broader markets and the different models that we have. So for example, I just put out an article today where we do back testing of the market direction classifier. Highly recommend going and checking that out. Now, one of the things that we have on the site that I think is very powerful and very neat, and I recommend, I highly recommend going and playing around with it because I think it's just a really cool tool to mess around with, is our workbench feature. And that's what I'm showing you here. So we have the price of Bitcoin in white in the background here. Then we have Bitcoin's momentum bias indicator here going down. And I'll walk through the different things that I've added to this chart to make it a little bit more visually appealing, or just kind of to help delineate different aspects of the MBI. So if you're not familiar with the MBI, momentum bias indicator, it basically quantifies how much momentum is in the market. Is the momentum bias to the upside, which would be bullish, or is the momentum bias to the downside, which would be bearish? So you'll see that at these market cycle tops, the MBI gets really overextended. It gets really far up, saying that momentum is getting to an extreme level, and that at those points it usually has to kind of mean revert, go back down to the downside. You also see in bear markets, you spend a lot of time down below zero, so that's what this horizontal line is at zero, but a lot more time below zero than above. You kind of get these breakouts, these kind of attempts to reestablish positive momentum bias that get rejected back to the downside. Very much just bear market behavior. And then you transition to this transitionary period, this oscillation where you kind of hang out around neutral. Kind of have this oscillation around zero where you're going above it, coming down below it, going above it, coming down below it. And that then builds into these periods where you go off and have your big blow off top. And we've been talking extensively on the channel about how more recently we had been in very telltale bear market behavior. Really ever since November of 2021, going all the way down through the June crash and then through the FTX collapse, really just bearish, not able to get to the positives. And if we did get to the positives, weren't able to hold it long before getting rejected to the downside. Now, more recently, what we've been seeing is that we've shot off to the upside. So, the MBI now is in the positives. In fact, it's at levels that we haven't really seen other than in these kind of transitionary periods back out of bear markets into bull markets. I've talked about this in a recent video I made, that the MBI for Bitcoin is starting to look more like this transition behavior out of a bear market into maybe more of this sideways or even possibly recovery phase than it looks, when it's just going down. We're not setting in new lows and negative momentum like we did in these prior bear markets, suggesting that, the possibility of some upside is plausible from that perspective, from the MBI's perspective. And indeed, we've seen a lot of upside already. So I want to now talk a little bit about how I made this chart. So if you want to go and make a chart like this yourself, you know how to do that. So you'll see that up here, I have 4 different things that I have open up here. So the first thing I have is just the Bitcoin price. So that's set here as M1. That's this white line. I then have the MBI set as M2. And if you want to add metrics, you just do it over from this panel over here. You just say add metric. And then, I can show you. You would just say Bitcoin and then something like the MBI, for example, if you wanted to add that. So that's how I created this. And then I have these 2 formulas here. So this first formula I have here is just to draw a horizontal line at zero. Now, this is some functionality that we're going to add, and we're hoping to add more tools to make drawing lines easier. But for now, this is the way that it tends to work. That So we're still improving the functionality of the workbench, but for now, if you want to get a horizontal line, the way it works best is just to take some metric. And if you want to add 0, I just took metric 1 and just multiplied it by 0, and that'll put a line right at 0. So it's a little bit of a roundabout way to do that at this point. Again, we're going to be expanding the functionality to make it easier to do this type of thing in the future. But for now, that's just what I did there to create that horizontal line at 0. And then the kind of the key formula is this F2. And this one's using this if function over here. And basically what it's saying is that if M2, which is the MBI level, is greater than 0, which is that formula 1 that I just made. So basically if it's greater than 0, I could have just put 0 in here also, but I just used that formula. If it's greater than F1, so that's 0, then it will equal MBI, so equal to M2. And if it's not greater than 0, it'll just equal 0. And so what that's going to look like is that this new formula, if you're above 0, this formula is going to show up, this F2. And if you're below 0, it's not going to show up. So basically I have the MBI set to be pink, and then I have formula 2 set to be light green. So when you turn on formula 2, it'll show up like this, where it'll go over the top of the MBI M2, so it'll show green when you're above 0. And then M2 is what's going to be showing below, and that's going to be when you're below 0. And so you can just create a chart like that, so when you look at it, you can just visually see when is the MBI above 0, when is the MBI below 0. So if you want to make this chart for yourself, that's how you could go and do it. These are the formulas I created and the way that I set this up. Different ways you could do this, play around with it for yourself. You can find other ways that make sense. But I like to look at it this way because it's useful to have a visual of when the MBI is above 0 versus when it's below 0. So I was saying that we're kind of maybe in a point where we're transitioning out of this kind of extreme down into kind of more of an accumulation, something that maybe looked more like 2015. And maybe you could even argue that even though we made a lower low over here in November relative to June, that maybe the market really kind of started to change its flavor back here in this June low. So I actually want to talk about another formula I created that I think gives some interesting insight. And this combines insights from the MBI and actually the upside downside potential indicator, or UDPI, our risk indicator here at the channel. So I want to talk about what this is here now. So to give some context of what we have here, I'm going to turn on these one by one. We have the long-term UDPI. So this is the macro version that cares about moves that play out over months, so kind of the longer-term focus. And you see it does a good job of quantifying risk across the market. When the MBI, or excuse me, when the UDPI is high, that indicates high risk. That tends to happen at these topping out points. UDPI is low, that's low risk. That tends to happen at the bottom of bear markets, before you go and move on back up. We have that up here. We also have the MBI, which we're just looking at. And then I created this formula, this F2, which I think gives some interesting insights. And so basically all that this formula is I'm multiplying the long-term UDPI, M2, by the MBI, M3. And so the way this is going to work is that the UDPI ranges from -5 to 5. So -5 is lowest risk, 5 is highest risk, or minimum upside potential, maximum downside potential. And then with the MBI also is something that ranges, it's a z-score, so it'll be denoted in standard deviation. So 0 is the average, anything above that is units of standard deviation above, and then below is units of standard deviation below. So for example, when the MBI is up at 1.4, that would suggest 1.4 standard deviations above the mean. When it's down at negative 0.43 or so, 0.48, that's 0.48 standard deviations below the mean. But importantly, the MBI will range from positive values to negative values. And so what you can do when you multiply the UDPI by the MBI is basically what you're going to get with this formula is extreme points, points where both momentum and risk are extreme. So if momentum is extreme to the upside, that would be a positive value, positive MBI, and risk is extremely high, that would also be a high value. That should then give you an especially high value when you multiply them together. Positive times a positive is a positive value, and if those two things are large numbers, it should multiply to be an even higher number. If both the UDPI and the MBI are low, they're both going to be negative. You could have a negative UDPI and a negative MBI, and when they're both extreme, negative times negative will equal positive. That should also mean a high positive value. And so what you'll get when you do this is these spikes that you'll see, where you kind of are spending a lot of your time down in this kind of trend, kind of this area down here at the base. You'll see these spikes that come out, these kind of anomalies that diverge from this kind of normal range that this metric would sit in. And you'll note that those spikes, those extreme points, tend to happen at turning points in the market. All the way back here, you get a big spike up at the market cycle top back in 2011. You get another big spike at the bottom of that bear market in 2011. You get another spike here at that interim peak in 2013. You get another peak here at the all-time or the market cycle peak for the 2013 cycle. See another spike kind of deviating from the normal over here at the bear market bottom in 2015. And then we get another spike over here in 2017 in December. And then again, a spike at the bottom of the bear market, spike during the March 2020 crash, and then spikes here during the top or the rounded top of this market cycle over here. And then we see another spike over here in the June lows. Now, you could look at this and say, all right, so it seemed to do a pretty good job back through this phase of identifying these turning points, right? The spikes happen either at the cycle top or at the bear market bottom, depending on what part of the cycle that you're in. But you might say, okay, but did it start failing over here? It's spiking up during this part, but not catching what was technically the all-time high here in October to November of 2021. And then it's also spiking here in June when really the bottom, at least so far, of this bear market was over here in November. Well, it's possible. What I think is what this is getting at more so than maybe from, just like technically what was the top and the bottom is kind of the feel of the market when kind of the extreme end of the mania phase of the bull market back in 21 was happening and maybe the end of the extreme kind of bearishness in June 2022, even though we went lower. It's one of the things that's been happening with crypto and with Bitcoin that we've talked about before and others have talked about is that back through this whole point, the price action was much more driven by kind of organic price action, by organic supply and demand dynamics. You didn't have nearly as much leverage or as many massive, institutional players in the space. And so it's much more driven by, psychology, just normal kind of market behavior from price movements. Whereas as we've gotten more into these points, we're getting more into these places where there's a lot of leverage in the system that creates distortions that kind of messes up normal price discovery and normal market dynamics. And that can also happen on the downside where you'll have a situation like FTX, which creates a bunch of forced selling that maybe wouldn't have happened in normal circumstances if you didn't have all this leverage that was built up in the system. Because again, the reason why this crash, or a big part of why this crash happened, you had all these institutions that were leveraged. You had Alameda that had borrowed crazy amounts of money, which with them going down then caused solvency problems with the people who had lent to them, which then created a bunch of forced selling of assets that may or may not have happened had that collapse not happened. And so the market is becoming more kind of influenced by these outside events that aren't really as influenced by just raw dynamics. And so really what we're seeing here is that the kind of extremes from a momentum and risk point really kind of happened at January going into kind of February and March here in 21, and then June 22 were kind of those extreme turning points from a momentum and risk perspective. And it didn't in this case mark the absolute top or the absolute bottom, but it was pretty darn close. And then what generally happened is, even though we had this relief rally, some people have even argued that after this mania phase, this was just a dead cat bounce that happened to put in a new all-time high. It was really part of this bear market we saw. And so what's also then possible is that this spike here kind of marks that turning point out of the bear market into maybe a change in pace into a new, if not bull market, at least accumulation phase, even though we technically went and set a new low. But notably, this new low that we saw, and we can see it from the MBI, or actually rather, let me take this off here, put the MBI back up here. We can just go ahead and see that the extreme of momentum downside happened in June. We didn't get nearly as much of a drop off in this move from the FTX collapse. The momentum behind that collapse was a lot weaker than we were seeing leading into that June collapse. And so that's why we're seeing on this formula this spike here, but not really as much of a spike during the FTX collapse. A small one, but not as large. So what that might mean, and again, we're going to have to wait and see. It's too early to tell this definitively right now, but there's a possibility that this really did kind of mark that turning point for the market, that even though we went and set a new low, maybe this is really this beginning of a longer term accumulation phase, maybe something more like 2015, that could ultimately then lead into a new move up. Time will tell, but it'll be interesting to see. And this insight here, just making this metric, and again, I just made this today, so who knows? This has no real-time validity. I haven't looked at this in real time to see if it predicts of the future, but it'll be interesting to keep in mind. And this was enabled by the workbench. I was able to create this because I have this tool here, I have the metrics there, I just could very easily go create this formula and say, oh, that's interesting. When you multiply these together, you get this kind of interesting pattern where you get these big spikes at important points in the market. So it'll be interesting to watch this go forward. And I also encourage you to go on the workbench, mess around for yourself, make your own indicators, multiply different things together that you think would make sense to create some kind of metric. Curious to see what you find and if you think you find something that is useful in looking forward. So we'll see if this particular formula is useful going forward, but I just wanted to note it here. And as also as an example of how you can use the workbench. Now, the final thing I wanted to talk about before I wrap up this video is just going over the stock market. So I'm pulling up TradingView here, and I just want to show what's happening on the S&P 500, because this is something I talked about in previous videos. It's something I would see as being a pretty bullish development if it happened. And it looks so far, as I record this on the 27th of January, like we might get this, where we'd had this descending resistance on the stock market for a very long time. We've bounced off of it once, twice, 3 times, 4 times, 5 times. And now on the 6th time that we've been testing it here, we finally broke over it. We finally broke into the upside. And that also corresponds to a pretty definitive break above the 200-day moving average, which you actually can see we pulled back and tested, and then we went off to the upside here. Why am I talking about this in a video where I talked about the MBI? Well, the reason is that one of the things that we can look at on the MBI is that we want to see this kind of behavior on the MBI moving forward to think that we're maybe transitioning out of the bear market into a new bull market, where we oscillate around zero, we spend a decent amount of time above zero, and then kind of go back below it, up above it, back down below it. And really one of the ways that we could see that continuing is that if this current rally in crypto continues, if Bitcoin continues rallying to the upside or at least not dumping, that will probably correspond to momentum bias that can spend more time in the positive zone, kind of help pull not only Bitcoin up, but then the broader crypto market potentially as well. And if we're seeing the stock market show bullish behavior, breaking out of this resistance, and maybe now being able to sit in a higher high, a high, a low, maybe a higher high, maybe a higher low, that's suggestive of at least a short-term new uptrend in the stock market, which then could mean green light for risk assets, which could mean a green light for crypto, which could then translate into some of that behavior we'd like to see on the MBI as confirmation of us maybe getting out of the worst of the bear market into a possibility of a new bull market, or at the very least accumulation that could then transition to a bull market down the line. There's still a lot of things that need to happen for all that to play out, but this is a key first step I thought we needed to see, and we're seeing it. If we got rejected here again and went back down, then I thought it was very likely the crypto rally was over. But seeing this, I think it's now more the possibility or the probability of the crypto rally continuing has gotten better, in my opinion, seeing this play out in the stock market. So I wanted to point that out. So overall, kind of what I want to talk about this video is what I'm seeing on the MBI and how this could be a bullish development. Kind of this new kind of metric that I just threw together is a simple multiplication of the long-term UDPI and the MBI, and how it seems to identify these key transitionary periods, which if this plays out would actually suggest the tenor of the market changed all the way back in June, and now we're just kind of playing out that transition as we've been going through. That this has really maybe just been a long-term accumulation zone from this model's perspective, maybe something like we saw back here in 2015, even though we never actually set a new low at this second dump over here, like we did over here if we're making that analogy. But it very well could be. So none of this is financial advice. You should make your own opinion, interpret these data as you will. But I think the possibility of this being a transition period is there, and the data are starting to suggest that that's something. And so for the people who are perma-bears, who are just calling for lower and lower prices, I think the risk to reward of being a bear is kind of a lot lower now than it was at earlier points in the bear market. And now we're getting to a point where having a long outlook, kind of a bullish outlook, is becoming more reasonable than it was back to the entirety of last year. So I'll have to keep watching things, see how things play out, but something that I wanted to talk about here. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, and go check out Polarity Digital for yourself. Love to hear your feedback as you go and play around with it.